Price, that's the number one technical indicator.
You do best by investing for the longer term.
If you can't explain what the business is doing, then that is a huge red flag.
Some technological change is going to put you out of business.
It really is a genuinely extraordinary situation.
Hello everyone, I'm Ed Gotham and welcome to another episode of Opto Sessions, where we interview the top traders and investors from around the world, uncovering their secrets to success. We've got Jon Maier from New York on the show today, who is currently Chief Investment Officer at GlobalX, the highly respected provider of a range of interesting ETF products such as LIT, the Lithium and Battery Tech ETF, as well as model portfolios. Previously, Jon worked at Merrill Lynch Wealth Management as a senior portfolio manager for its ETF Model Portfolio business. Now though, Jon shapes GlobalX's market outlook, leading on the construction of all model portfolios. We had a great chat about assessing your risk profile, constructing a portfolio to achieve different goals, as well as highlighting some interesting themes from the equity thematic disruptors portfolio. Enjoy. Hi Jon, great to have you on the show. You're in New York, I believe. How's everything going there?
Hey Ed, how are you? Thanks for having me on the show. New York is pretty good. So it's a sunny day today, and each day it seems to be the streets get more crowded. Been trying to model a fairly normal life, pre-COVID type of life. I walk my son to school every day, take the subway to work. There's a handful of people in the office as we migrate more towards the new normal of having people come in, yet with some flexibility.
Yeah. That's much the same as us in London, actually. I work in the city, and people are coming back now. It's getting busier, but optional on coming in. So there's about half people that are in at the moment. But it's nice to get a bit of normality back. The shops have opened up recently as well, and I think from next week people can start going to restaurants again and stuff, which should be lots of people waiting to do that.
And that's great.
And in New York, are people going? I don't know what sort of stage they're at. Have they opened up restaurants and things at the moment?
Yeah, restaurants are open. I had lunch yesterday with a colleague, and I have a business lunch scheduled for tomorrow. It's, I believe, next week. Everything's at 100% capacity.
Oh, wow. That's cool.
And Broadway opens in September, which is still a ways away, but moving towards having a full city again, which will be
that's
really
awesome.
nice.
It's great to see that we're moving ahead on that. So I wanted to quickly start by asking your opinion on the equity markets over the last year have had sort of huge inflows. It appears to be more of an expansion of the market. Well, maybe both of these things are happening, but more of an expansion of the market rather than just the same people just becoming more speculative. Do you agree with that? And if so, what does that mean for the future of people in the stock market?
Yeah, I mean, some of it is anecdotal in the sense that there are certainly online trading platforms that have seen a new user base, a younger user base, and a user base that really has had not much to do over the past 13 to 15 months as we've sat home through the pandemic. Combine that particularly in some of the developed markets where there has been higher savings rates as a result of money from government programs. So even for folks who have been unemployed, there has been still a income source. And with in the U.S., the Fed being having easy monetary policy and fiscal policy with both Congress and the Fed, you are seeing a risk appetite.
Yeah.
So I think that's fair to say that there's been a broadening base. Will it continue? It's unclear. It's not always going to be as easy to make money. The stock market is not going to always go in one direction. It kind of moves in that direction over time.
And
but there has been a short move.
Yes, CIO at GlobalX.
I would say that would change.
Which produces a number of ETFs and model portfolios. You're in charge of the model portfolio, I believe, and are you able to introduce people to what those are, how many different sort of portfolios there are, etc.?
Sure. I run our model portfolio business. We have 12 different model portfolios. We have asset allocation models, which we call our core series, which includes stock, bonds, and cash. We have thematic portfolios, which really speaks to our DNA at GlobalX, because we do have many thematic ETFs. We have a China sector portfolio. We have an equity income portfolio, because many of our ETFs focus on income, but income coming from equities. So we have 12 in total. It's a fairly new business relative to GlobalX, not that GlobalX is so old. But it becomes a kind of the second generation of, okay, we have a slate of ETFs. What are we going to do with these ETFs, and how do we holistically put them together? And we do take an open architecture approach. So it's not just GlobalX ETFs in our model portfolios. There's a couple that are purely GlobalX ETFs, but for the most part, we do take an open architecture look at the broader ETF universe to provide the appropriate exposure, particularly if we don't have that specific exposure within our suite.
Yeah. And so these model portfolios are basically combinations of various ETFs. Some are available at GlobalX that you'll use, but you'll use other ones as well. And you're packaging them up for intermediaries, and potentially there's some sort of offering for retail as well.
Yeah, ultimately the end user is the retail consumer. They are distributed through financial advisors on different platforms. So we're currently on 11 different platforms in the U.S. We have expanded globally as well, into India as well as Mexico. We will be having, as our UCITS business expands in Europe, I foresee a portfolio within Europe in the coming months as we broaden our ETF lineup in Europe. And
some of these ETFs, the model portfolios, are constructed in relation to individuals' risk profiles. My question here, which is, many individuals, especially people that are relatively new to it or haven't been in it too long, they might not know their risk profile. Do you have any insight on how they might go about discovering what that is, or where would you start, etc.?
Sure. With respect to risk tolerance, we build portfolios. Our asset allocation models, we have a conservative model, we have a moderately conservative, a moderately aggressive, and aggressive. So there's 5 basic risk profiles. So an investor usually falls into one of those categories. The financial industry has tools in place to ascertain risk tolerance. There are digital applications and surveys that can assist an investor. Also, financial advisors can assist an investor to determine where their risk tolerance lies. You have different types of portfolios, like our thematic disruptors portfolio, which is a more growth, more momentum-oriented portfolio. And one would say it's higher risk. And then you would decide how that type of portfolio fits into your broader asset allocation. So a thematic type of portfolio is more forward-looking, is taking the view that next time it's going to be different than the last. And when you typically build an asset allocation model, you're looking at repeating patterns from the past. So you're kind of fusing 2 different concepts together, and you just have to use that thematic portfolio in a moderated way based on the risk tolerance of a specific client. And some of these digital applications and these surveys really help an investor really determine where they should be, when they're going to retire, what are their goals.
Okay, and so this is typically something a financial advisor would go through with someone to ascertain that early on.
Yeah, the client would go through their financial advisor. Their financial advisor usually has tools available to them, made available by the firm that they work at, to ascertain the risk tolerance. And
got you. Now, I'd like to dig into these model portfolios in a lot more detail. Before that, I wondered if you could possibly give us a brief history of your career today, because you've been a few places across your career, and it'd be interesting to know what you've learned from those places, and also just a bit more detail about specifically what you do at GlobalX.
Yeah, so I've been in the industry since 1996, so I guess I'm starting to become an old timer. I started my career at PaineWebber, which was ultimately purchased by UBS. I started at PaineWebber right after I returned from the Peace Corps. I lived in Ukraine for a couple years, and when I returned, Ukraine is an emerging or frontier market, and I felt like I had this great experience as working in an emerging market. But what I found was trying to get a job on Wall Street back in 1996 was that, yeah, I lived in an emerging market, but I didn't really have any real skills that would help me get that job other than saying, yeah, I live there. So I had to convince somebody to give me a job. So at PaineWebber, I was hired as a research associate, assisting the analyst covering closed-end funds. And closed-end funds can be invested in many different things, and whether it be equities or fixed income, and many in the U.S., many of them are leveraged. And so I did that for a while, and then concurrently, the ETF business started to grow. So over time, I got promoted, and I would write primers on the ETF business, as well as covering closed-end funds. So I was at UBS and PaineWebber for 11 years. Then I joined Merrill Lynch prior to Bank of America acquiring Merrill Lynch about a year prior, and this was just before the financial crisis. And I was hired as a research analyst covering closed-end funds. And a couple of years into my stay at Merrill Lynch, after Bank of America took over Merrill Lynch, I was asked to take over some of the model portfolios that they were running, which were it was a very small operation. They were created in 2005. The ETF business was pretty small in 2005. Wasn't as differentiated and segmented as it is today. So when I took over the models in 2009, which the models really followed Merrill Lynch's asset allocation. So they were there just for a way to actually invest in the asset allocation. I said, wow, the ETF market has grown since these were created, and these portfolios really haven't received much love. And can I do something with them? Can I create something better? Put more segmentation within the models? And from 2009 to 2017, when I left, I built the model portfolio business at Merrill Lynch from virtually nothing to when I left, it was approximately $50 billion in assets. I would say of the 16,000 financial advisors at Merrill Lynch, half of the financial advisors used the model portfolios. They were called the Maier models, and I didn't ask for them to be called the Maier models, but just because my name was tagged to the models, and literally half the financial advisors used them, they gave them a name. It was easy to find in the system. Type in Maier, M-A-I-E-R, which is not the typical way you spell Maier, but they got used to it. That's how they found them. I'm not sure Merrill Lynch loved that they were called the Maier models. They don't like to brand it to anything to one specific person, but that's the colloquial name for the models. So in 2017, I left and joined GlobalX. And just to this is taking a while, but one quick step back was what I was doing in the models was kind of the early stages of thematic investing. So when I looked at a particular sector like IT, for example, information technology, I said to myself, what else could I do to get more segmented? And one of the things that I included in the models when I was there was cloud computing, as well as the internet or biotech for healthcare exposure. I'm like, and to me, it was looking at the future while looking at more of a traditional paradigm of asset allocation, putting, why is next time going to be different, and how can I be exposed in the portfolio? And when I came across GlobalX's product suite, I'm like, wow, they're really looking at the future and looking at ideas that next time is really going to be different, and how are these themes disrupting different sectors that were currently available. So I'm like, wow, this could be an interesting opportunity. And I was at a point in my career, I think I want to join a smaller firm and grow with that firm. And I just liked the product suite that GlobalX offered, and I liked the management team and the opportunity.
Yeah, it's funny you say that. It seems to be an incredibly interesting time for the stock market because it's slightly related to how all this innovation in the last last 30 years, but you can see it getting increasingly more rapid. You're getting all these new sectors appear in the stock market that weren't there before. GlobalX is one of the providers that offers ETFs that cover a lot of these areas. Really, there's not that many people in the industry that are doing a good job of that at the moment. I suppose that's why GlobalX is known for the thematic-based ETFs that they provide. So you essentially said that was the move from Merrill Lynch to GlobalX was about the opportunity that it provided in innovating in the financial instruments sort of area.
Yeah, I spent 20 years at two large firms, and when I joined GlobalX, when I was talking to them, we were about $3 billion in assets. When I actually joined and signed on the dotted line, we had about $5 billion in assets. So just in a couple months of that period back in 2017, we grew a good amount. And I felt the product suite was really looking towards the future, and I thought the management team was very innovative. The current CEO, Louis Baruga, and I really connected on strategy going forward. And I also saw how GlobalX was really building itself. While we were a much smaller firm 4 years ago, we have every functional area from research to marketing to product development. And each of those areas over the past 4 years have really grown in outputs, in the amount of people in the departments, and just the way we think. And research really has driven this firm as well. Jay Jacobs, who heads our research department, I'm going to get the number wrong here, but I believe there are about 12 people in the research department at this point. So all of the products that we actually come out with, we support with research. And it's not always saying that this theme is great right now, but this theme has potential for the future. And here are what the companies are doing within that ETF. Mm-hmm. And the great thing just generally about an ETF, whether it be a thematic exposure, whether it be financial technology or electric vehicles or video games and esports, you're including companies within that ETF. So you're providing some amount of diversification by having 20 or more companies within the ETF. Then not all of the ETFs, all of the companies within the ETF map to the same sector. So there is some inherent diversification within many of the thematic ETFs, which I think is a little bit of a misnomer in the market.
Mm-hmm. So model portfolios, I like to dig into the options there a bit more. It's quite a few different things you offer. Just before we start doing that, do you actively manage these portfolios in some way? Are they updated, based on changing market conditions over time and things?
So the ETFs, most of our ETFs are passively managed. The actual ETF, not the portfolios. So the ETF follows rules, the index rules. So that's one. That's the component that we're using for the portfolio. Now, when I create a portfolio, say our equity thematic disruptors portfolio, which is really designed to target those changing demographics and changing structural, how we view the market going forward, we are putting them together in an active way. So I like to say that passive is not really passive. Sure, you're using a passive instrument, are surrounded by an active strategy. Now that active strategy involves a couple different things. First, you have to select the ETF that you're using, select the specific exposure out of many different ETFs that exist in the market. So that's an active decision. Just using the actual ETF and the ETF structure is an active decision. And then coming up with a weighting mechanism, a weighting scheme to put them all together. For the thematic disruptors portfolio, we use forward sales growth as a weighting metric for the portfolio. And we typically reweight the portfolio on a quarterly basis. So it's both a qualitative and a quantitative process. The qualitative process is selecting a theme that we believe will play out over time. And then the quantitative process is actually weighting from the pool that's been selected, weighting the themes.
And can you tell us a bit about the construction of equity thematic disruptors, maybe highlighting some of the most interesting themes that you think have the highest potential?
Sure. Within so we have 10 different themes within that portfolio. Now, there's an adoption curve for themes, and themes could take 5 to 10 years to play out. Now, over the past year, we've seen an acceleration of many different themes because of the pandemic. Now, the pandemic really kind of flipped the paradigm, if you will, on the adoption curve. So if you think about fintech or social media or video games and esports to occupy our time, or robotics and artificial intelligence or cloud computing, many of these different themes really helped us carry through the pandemic. Now, a theme that's on a lot of people's mind right now is cybersecurity. And in the U.S., there was a ransomware cybersecurity attack on a pipeline, and that's
I saw that.
If you think about many different areas, whether it be hospitals or state and local governments, many have been attacked by cyber terrorists in a sense. So I think cybersecurity is a theme that really is very important and is going to continue to be with us in both protection of our personal data, which is very important, as well as protection of our systems. As everything is moving towards is more digitally and online, that's just a theme that's just is undeniable. And while it's pulled back a little bit this year, as there's been more of a rotation towards value, as there was a big run up in many of these different themes last year, I do believe that cybersecurity is very important and relevant. Also, another theme that is important is robotics and machine learning. And if you think about some of the demographic shifts that we are seeing in the world, you just look at China, for example, their declining birth rate. And how does that play out over time? Japan, robotics is big in Japan because of kind of the shifting demographics where there's an older population that needs to be taken care of in some way, shape, or form. And the robotic technology probably can assist in those areas. So those are two areas that I believe are very important, as well as many other. You just think about what happened over the past year. Imagine if we weren't able to store data on the cloud. We couldn't be doing what we're doing right now. Zoom really took off during the pandemic. And that kind of is intersection of the cloud and cybersecurity and other technology. So,
how do you choose and weight those different themes within the model portfolio?
So in terms of how we select the themes, so we look at a pool of themes, looking at the overall landscape and what's available in the market. Whether you look at cloud computing, video games and esports, social media, financial technology, and where they are in the adoption curve. So if you think about different themes, there's 5 stages of adoption. There's the innovators, and many of these companies really don't exist in the public domain. They're still in kind of private equity stages. Then there's the early adopters. And we're trying to look for an acceleration in revenue growth for the companies in the underlying ETF that we select. So we're looking for those companies that are in the public domain, where revenues are growing and adoption is increasing. And then we look at these forward sales growth numbers because we think that's a good metric, because some of the companies that are included within the ETF may not actually be earning money because they're in fairly early stages of adoption. So it was a metric that makes sense, and we're looking for that acceleration of that growth. Now, in terms of, we look at it in a few different ways. We look at 4-week reading of the forward sales growth numbers. We look at 8-week average over 2 years. And then we look at more of a stability bucket of the inverse of the standard deviation of the forward sales growth numbers. Probably more than your listeners want to hear, but then we put that together and select that comes up with the weighting of the portfolio. We cap the exposure at 15%, so that'll be the highest weighting of any team.
Okay. And are there any sort of disruptive themes that you're keeping an eye on that you're allowed to talk about that aren't available or aren't included in your equity thematic disruptor at the moment?
Well, one thing that I think is really important, and we do have sustainable portfolios, is just sustainable investing in general. Sustainable investing, for a long time, it was kind of a nice to have. It was more aspirational. And you just kind of step back for a moment. Sustainable investing really broadly describes an investment approach that incorporates environmental, social, and governance considerations, while at the same time generating financial returns. And many, particularly today in the US and around the globe, want to potentially facilitate positive environmental and social changes without sacrificing financial returns. And that's an approach sustainable investing offers. And it also offers it through a thematic lens. Now, with climate change action now being really important, it's an objective that needs to be dealt with both from a bottoms up and top-down approach. The bottoms-up meaning the companies need to facilitate or reduce carbon emissions in the way they produce their goods. And also there has to be a top-down mandate by governments to say, you can't do this, even if the companies are already on that kind of pathway to improving their supply chains and things like that. So top down and bottoms up, I think makes perfect sense. And in the U.S. right now, there's administration that's way more friendly to this approach. The U.S. has re-entered the Paris Accords Agreement. The U.S. can't go it alone. The U.S. has to work with the world to try to reduce carbon emissions. And it's really a global initiative. And it's a big area of investing. And I think it's an area that companies are looking to innovate. It's disruptive just by its nature. You look at solar and wind, and these are companies that could really tangibly improve certain environmental and social matters. And it's relevant on an industrial scale, and really could positively impact people, the planet. And at the same time, it could reward investors and translate into financial profits. So you're going to hear a lot more about sustainable investing, as well as sustainable themed investing.
Yeah, interesting. And do you think there was quite a lot of chatter early on when these sustainable ESG sort of stuff started coming through, that quite a few of the companies that were sort of claiming to be sustainable weren't actually sustainable at all? But do you think that's changing now, and that you're able to see some cleaner sort of ETFs with the constituents in really meeting the sustainability goals, etc.?
Well, I think that there's different ways to look at sustainability. There's the negative screens and the exclusionary screens, and there's the more inclusionary screens as well. So that there are different ESG integration approaches. So there's certain, MSCI looks at exclusionary methods to ascertain whether a company is truly, rates them and falling into kind of an ESG category. So, it's definitely a moving target. And with respect to sustainability and sustainable investing, it's evolving. And again, I mentioned earlier that it's aspirational. So if there's a demand for a company to improve the way they treat their employees, the way they produce their goods, that they have more diverse boards, and the customers are, they want to purchase goods from those type of companies, and certain goods companies want to do business with those type of companies that are being more aspirational and improving. I think that's kind of the path forward for on the ESG front. And many different themes you can look at through the lens of the UN Sustainable Goals: no poverty, clean water, not employing children, no child labor. So the world is moving towards trying to kind of meet some of these goals, and many of these companies and again, it's aspirational.
Yeah, it's always going to be difficult because it's controversial, isn't it? Talking about some people think things are only incredibly sustainable and clean if they meet these really high criteria. And an example I've heard used before is nuclear, I think. Whereas a lot of people aren't a fan of nuclear energy because obviously nuclear waste, etc. But it's apparent, as far as I've read up, it's one of the only ways it's going to sustainably get us off fossil fuels. So it's a comparatively a better alternative, although may not be the most sustainable thing that we could get, I suppose.
Yeah, and nuclear obviously is the issue of what if there's an accident.
Yes.
Ironically, I lived in Ukraine, which was I lived in Kyiv, 60 miles from Chernobyl.
Oh wow!
So I think many would argue that nuclear, just because of the risks of an accident, obviously the accident in Japan poses a risk. Yeah, it doesn't. Barring any sort of environmental disaster, then sure, potentially it's a clean source of energy. But where do you put the plutonium? You still have to store the waste. So that's somewhat of an issue. But in terms of sustainable investing and ESG, it is somewhat of people have different views on it.
Yeah.
So what's socially responsible to one person is not necessarily to another person. So it's hard to clearly define what that means.
We hope you're enjoying the episode. For interviews like this every Thursday, subscribe wherever you get your podcasts. And while you're there, make sure you give us a star rating and leave guest suggestions along with any other feedback in the review section. Now, back to the show.
So I think it'd be an interesting segue now into another selection of your sort of portfolios, the core series and sustainable core series. I think those are quite new, which are balanced, I think, in different ways compared for different risk profiles, using a mixture of strategies and asset types. Are you able to go into some detail about what these are and how they're constructed and to meet their goal, basically, how they differ in that way?
Sure. The core series is that's our asset allocation suite, and then the sustainable core series, which looks at sustainability at the sustainability components using the same asset allocation. So I briefly mentioned earlier the core series uses stock, bonds, and cash, and has 5 different risk profiles from conservative to aggressive. And what the core series and the sustainable core series have in common is that we include thematics. Within the sustainable series, we have kind of three buckets. We have the bucket that includes just your typical asset allocation, where you're looking at ETFs that are more exclusionary. We also include thematics, looking at them through the lens of sustainability. And then we also have that clean tech bucket for the sustainable portfolio. But the other core series, the non-sustainable core series, we do include thematics in all of the risk profiles, and it's in a moderate portfolio. We scale in an appropriate amount of the thematic disruptors portfolio into the core series to provide the end user with a full exposure of your typical asset allocation of stock, bonds, and cash that's providing diversification between equities and fixed income. And when you're building an asset allocation models, you're looking at the past. You're looking for commonalities from the past to build that portfolio. But when you're adding in thematics really are different. Next time is going to be different. There has been nothing like it. The adoption curve is, as I talked earlier, it goes from the innovators to kind of the laggards. The innovators, early adopters, or early majority, late majority, kind of looking for that growth in the early adopters and early majority stage. And we're infusing that or scaling that into a portion of the equity exposure. So that's what I find really unique about these portfolios. And it's really building on some of the early concepts that I developed when I was at Merrill Lynch.
And could you just describe the main differences between a conservative strategy and an aggressive one, for people who are aware of how these things change and what makes something aggressive as it compared to a conservative?
Sure, it really comes down to your mix of equities and fixed income and your cash bucket. How much risk are you willing to take? Now, with fixed income, with rates being relatively low, although they have moved up recently, long rates have moved up in the U.S. If you really have to be positioned properly with respect to your duration. So, on the conservative portfolio, you'll have a lower proportion to equities. You'll have a higher proportion to fixed income, but the duration will be lower, so you won't have that much interest rate risk. Conversely, if you go to a more aggressive portfolio, that more aggressive portfolio will have a higher exposure to equities, a lower exposure to fixed income. We still manage the duration based on market conditions. The duration will not be as short as a conservative portfolio.
And have you ever considered, there's obviously been a rise in the new asset type, digital assets essentially, or crypto. Have you discussed that at GlobalX? Is it something you're interested in? And how, if so, how would you incorporate something like that into your model portfolios?
Well, right now, everyone's talking about cryptocurrencies, whether it be Bitcoin or Ethereum or Dogecoin. But you remember that the portfolios that I built are ETF portfolios. So in the US, there's no ETFs that have direct exposure to cryptocurrencies. There's some ETFs that have some tangential exposure to the blockchain technology. Right now, it'd be pretty difficult to include in a portfolio, at least the portfolios that I built. Now, argument's sake that an ETF, a Bitcoin ETF or Ethereum ETF actually existed. The question is, would I include it? And I would say that it's a very new asset class and it's very volatile. I think I would have to build a new portfolio and would be pretty always transparent, but prescriptive in what this portfolio could potentially do or not do. And so the type of portfolios, the core series portfolios, I just don't think there's a home for digital assets at this point, even if I had the ability or the vehicle to use in the portfolio. So,
yeah, okay, fair. And obviously another big ETF provider in the space is ARK. Is it something you actively try and differentiate against? I'm not sure if they offer model portfolios per se, but are you thinking about this sort of
They do provide SMAs using single stocks, I believe. The ARC ETFs are actively managed ETFs. Our ETFs are not actively managed. For the most part, they're not actively managed. We have a couple, but we don't actively try to differentiate or be the same as ARC or the ARC Innovation Fund with respect to our thematic portfolio. But what I can say is that our thematic disruptors portfolio is a lot more diversified than something like an ARKK. If you think about how many positions based on companies, so if you aggregate the companies in the ETFs that we include within the thematic disruptors portfolio, there's probably over 500 companies. The ARC Innovation Fund has much less and more concentrated exposure.
Wow.
So they're very different types of access points to thematics. So we don't explicitly try to go after or try to be the same or different. We're trying to build a thematic portfolio that provides what we believe are the right themes that are going to tackle and capture changing technology going forward in the thematic disruptors portfolio. So, it's inherently there's more sector diversification within our portfolio as well because we have over 500 names in the portfolio.
Yep. And just swinging back to sort of macro trends we touched on at the start of the interview. A big thing happening at the moment is this sort of inflation narrative. We're starting to see now that it's apparent that inflation is coming in. So even today, May 12th, some of the data came out today on CPI. I think it's 3% versus 2.3% expected, a lot higher than expected. 10-year yields have gone up because of that, because of the inflation sort of expectation going higher. What do you think are the consequences of rising inflation for equities over the next year or so, or even going forward further?
So we have a very unique situation. We've had a pandemic that most of us have never lived through. And then we've had central banks around the world, as well as governments, that have been actively trying to plug the holes as economies were effectively shut down to prevent the transmission of COVID-19 around the world. So within the U.S., you had a tremendous. The Fed was proactive, providing a tremendous amount of support, cutting interest rates, buying securities to stabilize the market. Then you also had on the Congress in the U.S. providing a tremendous amount of support through stimulus programs and unemployment benefits for the unemployment rate went up. There at the peak of the pandemic, there was about 20 million people in the U.S. that were unemployed. So there was different programs for small businesses to help them operate through the pandemic. So to provide assistance so they wouldn't have to fire certain employees. So there was a tremendous amount of support, and that was a positive and necessary. And other central banks around the world also did many things for their populations where they could. Now, over the course of the year, or 13 or 14 months, as vaccines have been effectively distributed in the U.S., we are starting to see the economy start to reopen. And you've had a kind of a confluence of events of one, the pandemic, two, if you go back prior to the pandemic, you had a different administration in the U.S., which was more of a populist administration. And with China, they were imposing tariffs on China. So there was already going on some disruption in supply chains prior to the pandemic. Now you add in the pandemic when it was very difficult to move goods around the world. Many factories around the globe shut down. And there's a lot more interconnectivity than one would think. China is a is a very important player in the world. China produces lots of inexpensive goods and components for different items around the world, whether it be in Europe or the US. And with the disruption in the supply chains, and now that things are being turned on, economies are people are traveling more, more building is occurring. And while there's a lot of people unemployed in the US, there's at the same time, in a strange way, there's a scarcity of labor in certain areas, which is causing to push up wages in certain areas. And the cost of many different goods are going up. Almost any commodity that you can think of, whether it be corn, heating oil, wheat, natural gas, cotton, lumber. Lumber prices in the US have gone parabolic. The cost to build a new home in the US has increased. The average new home has increased an average of $36,000 just based on lumber prices. So these are all components that are certainly inflationary. And the question is it transitory or is it more permanent? And the Fed has been pretty explicit that they want the economy to, they are overshooting their targets, and they're not doing anything about this heating up right now. Because if you look back to the financial crisis post, there was a good amount of central bank intervention, and there were some stimulus packages, but not enough. And there was slow growth for the next 10 years, which could have been some of the reasons for the rise in populism in the US and around the globe. So the question really now is it transitory or is it more permanent? And that's an open question.
And so by transitory is almost sort of because of the supply shock and the reopening happening quickly, you're basically, there's too much demand now, but it will stabilize potentially in the future as things, start to calm down a bit. That's what we're saying when it's transitory, are we?
Yeah, I mean, the Fed, policymakers, and other economists they're basically dismissing the current round of numbers as transitory, and that they're expecting that inflation settles down later this year around the 2% range targeted by the central bank. Mm-hmm. So what's interesting is long-dated U.S. Treasuries just rose modestly based on these numbers. Today, they came out in response to the higher readings, and so that's sort of suggesting that market participants aren't really seeing any material change to the Fed's assessment of the economy, and that inflation really is just being driven by external factors rather than domestic overheat or weak employment data that came out last week. And that's longer term, that the main risk really is that the U.S. recovery will be slower than anticipated, and the imported inflationary pressures will kind of subside. But again, some of these numbers actually could be vetted out when we see some of the retail sales numbers, which are coming up next week.
And given all these unknowns in the market, how would you go about portfolio selection, for example? How do you address this uncertainty, given it, some things that have just never happened before, and two vastly different scenarios? If we go into stagflation, or if it's just transitory and we start, growing again normally.
Yeah, I mean, I'll take the stagflation part first. Is the problem today is that we're recovering from a negative aggregate supply shock, and you have had very loose monetary and fiscal policies, which in theory could lead to inflation, or worse, stagflation, which is just high inflation alongside a recession. But we pulled out of the recession. But if you think back to stagflation of the 70s, that really came out of negative oil shocks from following the Yom Kippur War in 1973 in Israel and the Iranian Revolution in 79. So you had multiple exogenous shocks. Right now, I don't necessarily see an exogenous shock unless you have Taiwan or China takes military action against Taiwan, which certainly would be a shock, and that would cause a lot of manufacturing problems around the world. and would really disrupt global supply chain. So in today's context, we need to worry about supply shock as threats to potential growth and as possible factors driving up production costs. And you're having this move towards deglobalization and rising protectionism and these post-pandemic supply bottlenecks. And that's where we are today. And you are seeing a lot of global supply chains trying to reshore, but reshoring is not necessarily is not an easy thing. It takes a long time. You have to build factories. You have to move around employees or find markets that are providing cheaper labor. So I think that's kind of feeding into this whole narrative of you're seeing the shift from growth to value because you've seen growth stocks move up in a meaningful way, and that partially is a result of the use of many look at technology companies and how we're using technology, how we have used technology over the past year, and now that the economy is reopening, and we're talking about huge infrastructure packages in the U.S. And what are the sectors that are going to most benefit? And then you're also having a reopening of the service sector. Planes are flying at full capacity. People are visiting hotels and traveling in the U.S. again. So you're seeing that natural shift. And material companies, industrial companies certainly would benefit from infrastructure packages, but you're just seeing also a lot of building in the U.S. too, and the shortage of supplies are playing into that as well. So having a focus on value or themes that are positively impacted by some of the policies that are going on, particularly in the U.S., like an infrastructure package, the infrastructure theme is certainly one that's playing out right now. So that would be an exposure that'd be really relevant, and we do include in some of our portfolios. But the long-term trend of growth, I do believe, will still march on, although we have had some pullback recently.
Yeah. And just moving the lens over to China a bit more, what do you, because for the last sort of 10 years, US has really been the big growth story in terms of equities, disregarding, what's happened over the last year, sort of rising and the crash and everything. Do you see China being somewhere as a big opportunity for the next 10 years?
China is the second largest economy in the world. And over the past year, their economic recovery built momentum. They're the only major economy to post positive growth in 2020. And they were very effective in controlling or managing through COVID. They have a very different type of government structure, obviously. It's more of an authoritative country. People call it a communist country. I'm not really sure it's a communist country, quite honestly. They are producing more billionaires than any other country at a very fast pace. So they are more capitalist with an authoritative political system. Now, I think China is expected to continue growing at a higher rate than much of the rest of the world in 2021. In its April outlook, the IMF revised its forecast for China growth upwards of 8.4% for 2021. And I think that's largely due to strong external demand tied to stimulus packages within advanced economies. And we've already seen a recovery in the industrial investment and trade data from China. And I think further growth will likely be aided by policies favoring a full recovery in consumption in China. And now, despite this, there's been a sell-off in China. And I think this could be partly explained by a rise in the 10-year Treasury yields, which supported the U.S. dollar and value-oriented assets and hurt overseas and growth-oriented assets. There's concerns over preemptive tightening in monetary policy, which also contributed to some of the sell-off. But China is a very important economy. They're an important trade partner. And even if you're not investing directly in China, you're in some way, shape, or form exposed to China. And I think China is an opportunity going forward.
And outside of China, are any countries that you believe offer some interesting opportunities going forward?
Yeah, I think Vietnam looks pretty interesting. They've done a really good job in terms of vaccinations. They have a cheaper labor force than China, so companies are looking to diversify their supply chain to production. So Vietnam looks interesting from that perspective. Also, they have a new administration of Vietnam, which is very forward-looking. There have been proposals for these mega economic zones where they're looking to foster high-tech industries and high-tech agricultural projects. So I think Vietnam has good growth potential.
Oh, interesting. Well, that's great, Jon. Thanks for all of the feedback there and interesting insights and stuff. I just want to finish by doing this quick fire round, 4 questions. Not looking for long answers, just first thing that comes to mind, and it's just something we do at the end of quite a few interviews.
Sure.
To kick off, name an investing hero you follow.
An investing hero. So this may sound a bit trite, but my favorite investing hero is my dad. My dad, he was a good investor. He retired really early. And something that I learned from him, and that I always think about, and it has some applicability to thematic investing, is that he always said, look towards an event. So I think back to my childhood. I grew up in New Jersey, and there was a highway that was to be built not too far from our house. My parents weren't thrilled how close the highway is to our house, but what my dad explained to me is that highway was which was Route 78, was going to open up a part of New Jersey that was not easily accessible. And he always said, buy something where there's going to be an event. And this particular event was a highway, and he had purchased land way before in areas that he knew this highway was eventually going to be opened. So the event was the highway to accessing different parts. And you can really apply that to many different areas. You think about like a computer before there was the internet. What was the real use case for a computer? Yeah, you can do some fun things on it, play some video games maybe, or create some code. But there was no major use case for the average person until there was the internet, until there was like interconnectivity. So the event there was the internet that really connected all computers. So I do think back to my dad about that highway example.
And next is a favorite book. Doesn't have to be one about investment.
So I've read a bunch of books lately, but one that has stuck with me is called Sapiens. Sapiens, it's a history of humans and how we have really thrived and how we've developed. I mean, what I've learned from this book, and it just rang true, is that humans have this incredible ability to really cooperate with each other, potentially, or fight against each other, really. And we have a unique capacity to believe in things that are just magical or just in our imagination, whether it be gods, religion, nations, money. And the author, Yuval Noah Harari, claims that all large-scale human cooperation systems, including like religion and political structures and legal institutions, they are the emergence to the human's ability to actually just believe in fiction. And money, which pertains to our business, is a system of mutual trust. And we have to believe that money has value and that someone will honor that commitment. And for example, you take your money and you deposit your money into a bank. You have to believe that bank is going to give back your money when you need it. And they can use it to make more money while you don't need it. And you can earn interest on that money. So it's a belief system. And obviously, we know the concept of running on the bank. If that system collapses, then the whole concept of money could collapse. Yeah. And it has happened in certain areas and regions.
An important lesson the market has taught you, maybe over the last year, but it can be whenever.
Don't get too emotional. Don't overreact. Obviously, look for trends. Look at things that are changing. Look to the future. Look at companies that are changing their business model. Everything changes. And if you don't evolve and adapt to and look towards the future, your company, your business is going to die. And you look during the pandemic, if a company didn't evolve digitally quickly, they didn't have a shot. What I do know is that over time, the broad markets have moved in one direction. Obviously, there's periods of time within that they go down. They go down for extended periods of time, but don't miss out. So you're nervous that you're invested in a broad market index, and you're nervous that something's going to happen, and you're invested in the S&P 500 is going to go to zero. That's very unlikely. It's never happened. So psychologically, you want to exit. But if you miss some of those up days, you're going to miss the strong returns you're going to have over time if you stay invested. And as a portfolio manager, we're obviously looking to kind of capture inefficiencies, capture new trends, but still don't get too nervous when markets correct.
And finally, what's your edge?
My edge. So I've been in this business, I guess, a long time at this point, particularly compared to some of the people at GlobalX. It's definitely a company that tilts younger. Not that I'm so old. So I think my experience is certainly helpful. Working at two large organizations, then moving to a smaller organization, which is growing pretty fast. We went from $5 to $32 billion pretty quickly. That's provided me a lot of knowledge and experience. I'm also a pretty casual person. So my current company probably is suited better to my personality than my prior two companies that I spent 21 years at. So my edge, I think, is my experience, my leadership style, which is casual, and just being honest and authentic. And I think that's carried me through my career.
Amazing. Thanks, Jon. It's been a pleasure to talk to you. Can you possibly let us know, or let our community know, where can they find your insights? Can they follow you on Twitter, or is there a blog you contribute to?
Yeah. So we have a website, www.globalxetfs.com. We have research from our research team, as well as research and macro research and information on our portfolios on that site that I and my team produce. I also have a Twitter handle. It's at Jon D. Maier, Jon, no H in John, JOND. So I periodically tweet.
Cool. That's awesome. Is there anything else you want to tell our community? I mean, all the ETFs are also available to look at on globalxetfs.com.
Yes. So if you go to that website and you go to explore our ETFs, we have approximately 82 ETFs. We have about $32 billion in assets. Some of our larger ETFs, which is our U.S. Infrastructure and Development ETF. We have LIT, which is our Lithium and Battery Technology ETF, with over $3 billion in assets. We have our NASDAQ 100 Covered Call ETF, QYLD, which has been of interest to many lately. Robotics and artificial intelligence. The list goes on. Copper Miners ETF has gained a lot of interest lately. It's COPX, as copper is used in production and connectivity, and with the increase in building and another raw material that is has moved up in price because of availability.
Yes. Brilliant. All right, Jon. Well, that's been great. I hope you've enjoyed it as well, and we'll catch up again soon, I hope.
Great. It was a lot of fun. Thanks, Ed.
Cheers, Jon.
Thanks for listening, everyone. Just a quick note before we sign off. If you're looking for an easily digestible daily update on the markets, this might be of interest. Opto Updates is our short newsletter sent every day during the trading week, giving you a bulleted list of the top 7 stories from the global stock markets. We've done the hard work for you, highlighting relevant opportunities and trends, and in addition, we'll also keep you notified of any new products, stock reports, or webinars from the Opto world. If you're interested, sign up using the link in the show notes. And thanks also to Co-Fruition for consulting on and producing the show. Until next time.